All right, let's talk about accounting. And no, don't tune out. We're going to crack the code on this thing. It's actually a 500-year-old system, and it's built on this idea of perfect balance that, believe it or not, runs the entire global economy. So stick with me, and I promise you'll see the simple, kind of beautiful logic that makes it all work.
So here's how we're going to break it down. First, we'll look at the one golden rule of accounting, the foundation. Then, we'll get into the simple little tool they use to make sure that rule is never broken. From there, it's all about the language, debits and credits. And finally, we'll see how it all just clicks together to build the big financial reports that tell you everything about a company's health.
Okay, first things first, we have to start with the foundation. This is the single most important, totally unbreakable law in all of accounting. If you get this one thing, everything else just falls right into place.
And to really get why this rule is so important, just try to imagine a company like Walmart. I mean, think about it. Billions of transactions, right? Customers, suppliers. How on earth do they keep track of all that without it just turning into total chaos? Well, the answer is this incredibly clever system that was actually invented by Italian merchants more than 500 years ago.
And here it is, the accounting equation. It's so simple, it's beautiful. Basically, it says that everything a company has, all its stuff, its assets, had to come from somewhere. It was either borrowed from someone, which creates a liability, or it was put in by the owners, and that's the equity. The main thing, the absolute number one rule is that this equation, it has to balance, always, no matter what, no exceptions.
So, how do you make sure that equation stays balanced with every single little transaction? Well, you use a brilliantly simple tool that makes sure nothing ever gets missed. Let's check it out.
It's called a T account. And yeah, it literally looks like a T. See, way back when everything was done by hand, accountants figured out pretty quickly that if you mix your pluses and minuses in the same column, you're just asking for trouble. It's a recipe for disaster. So they split them. This simple T shape puts all the increases on one side and all the decreases on the other, for any account, whether it's cash or loans or anything else.
Okay, so we've got the main equation, and we've got our tool, the T account. Now we just need the rules of the game. And honestly, there are only two main rules you really need to get. This is the language that makes this whole system tick.
And that language is debit and credit. Now listen, this is super important. Forget everything you think you know about these words. In the world of accounting, they have a very, very simple meaning. Debit just means left, and credit just means right. That's it. Seriously. Debit is the left side of the T account. Credit is the right side. Don't overthink it.
So rule number one, when you're talking about assets, things like cash, the left side, the debit side, is for increases. The right side, the credit side, is for decreases. It's that simple. If you get more cash, you debit the cash account. Boom.
Now, for the other side of that main equation, for liabilities and equity, the rule is just the exact opposite. It's a perfect mirror image. So an entry on the right side, a credit, is an increase, and an entry on the left, a debit, is a decrease. So if you take out a loan, you're increasing a liability, so you credit the loan account.
Let's walk through a quick example so you can see it in action. Let's say your company borrows $50,000 from a bank. Okay, two things happen. First, your cash goes up by 50 grand. Cash is an asset, and to increase an asset, we make an entry on the left side. We debit it. At the same time, your loans also go up by 50 grand. A loan is a liability, and to increase the liability, we make an entry on the right side. We credit it.
And right there, that brings us to the magic trick, the built-in self-checking system that keeps everything perfectly balanced. For every single transaction, the total amount of debits must equal the total amount of credits. In that last example, right, we had a $50,000 debit and a $50,000 credit. They're equal. The system stays perfectly in balance. It's foolproof.
Okay, that makes sense for assets and loans. But what about all the stuff that actually makes a business run? Sales and costs. How does the system handle income and expenses? Let's take a look.
All right, here's the key. You have to remember that any profit a company makes ultimately belongs to the owners. It's part of their equity. So revenue and expenses are really just temporary little changes to equity. Now remember the rule for equity. You increase it with a credit on the right side. Well, since making a sale, getting revenue, increases the owner's equity, you increase revenue with a credit too. And since an expense decreases equity, it uses the opposite rule. You actually increase an expense account with a debit. I know, it sounds a little backwards at first, but it makes total sense when you just trace it back to that core equity rule.
And now it's time for the payoff. This is where we see how all those little individual entries, all those debits and credits in our T accounts, all come together to paint the big picture. This is the real aha moment.
So just imagine, after a whole bunch of transactions, getting cash from owners, borrowing money, buying some equipment, we just tally everything up. We find the final balance for each one of our T accounts. And just like we'd expect, the asset accounts like cash and equipment have debit balances, and the liability and equity accounts have credit balances.
And now, watch this. This is where it all comes together. Those final balances we just calculated, they slot perfectly onto a big report called the balance sheet. All the debit balances, they go right onto the left side under assets. And all the credit balances, they go on the right side under liabilities and equity. And what happens? Total assets are $110,000, and total liabilities and equity are also $110,000. It balances to the penny. That is the power and the elegance of this whole system.
So now that we get the nuts and bolts, let's just quickly zoom out a bit. Because the balance sheet is just one of 3 key reports that really tell you what's going on with a company.
Right, so you've got 3 main reports that all work together. You have the balance sheet, which we just saw. It's like a snapshot of the company at one single moment in time. Then you have the income statement, which tells you if the company was profitable over a period of time, like a quarter or a year. And last, you have the statement of cash flows, which, as you can probably guess, just tracks where the actual physical cash came from and where it went.
Yeah, the statement of cash flows is awesome because it kind of cuts through all the fancy accounting rules and just asks a really simple question. Where did the cash come from and where did it go? It's the ultimate reality check, and it breaks that story down into 3 main parts.
So first, there's operating activities. That's just cash from the main, day-to-day business. Second is investing activities. That's cash used to buy big stuff, like buildings or machinery. And third, you've got financing activities, which is all the cash from investors and banks. When you look at those 3 together, you get a super clear picture of what's really happening with the company's cash.
So when you really see the logic, right? How it flows from a simple T all the way up to these major reports, it becomes pretty clear, doesn't it? Accounting isn't just some random collection of boring rules. It's this elegant, self-correcting system that's all about perfect balance. It really is the language of business. And now, you've got the key to understanding it.